90% of traders don't get stopped out because their market direction was wrong. They get stopped out because they placed their stop loss exactly where liquidity wants them to. 90%. Think about that. Most retail traders are out there literally feeding their accounts to institutional algorithms without even realizing it. You're trapped in this brutal cycle of getting hunted right before the market goes exactly where you predicted it would go. Look, one bad stop-loss habit can absolutely destroy 30 winning trades in a blink. You've been brainwashed, right? Brainwashed to think a tighter stop-loss somehow equals better risk management. Let me tell you, smart money loves traders who believe that. A tight, arbitrary stop-loss isn't risk management at all, guys. It's just blood in the water. All right, let's dive into Section 1, the hidden liquidity trap. Look at the complete psychological contrast here. Retail traders, they place a stop loss for emotional safety. They slap it exactly where they feel comfortable losing money. But institutional players, they operate with cold, calculated logic. They place stops strictly at the point of structural invalidation. They honestly don't care about feeling safe. They only care about objective market structure. And that brings us to the liquidity sweep. Smart money algorithms, they aren't magic. They're just highly efficient order matching engines. So when institutions need to buy a massive block of XAUSD, they need an equal amount of sell orders. And where do you think they find them? Yep, right where you and thousands of other guys put your stop losses, just tucked under an obvious low. To them, your stop loss isn't some safety net, it is literally a liquidity target. Moving on to Section 2, the anti-SL framework. We've got 7 unbreakable rules, and Rule 1 is big money logic. You've got to stop placing stops based on emotion and start placing them based on liquidity. Step 1, find outside structure. Step 2, never ever place your stop right below an obvious peak or trough. Step 3, spot where the liquidity rests before you even think about entering. You have to place your stop where smart money has absolutely zero reason to go hunting, period. Then we have Rule 2, structure or die. If you're out there placing a fixed 15-pip stop loss just because some YouTube guru told you to, you're not trading, you're gambling. We do not trade pips, we trade cash flow behavior. An institutional stop loss must sit outside a break of structure, a BOS, or outside a Wyckoff accumulation boundary. If there's no clear structure, there's no logical stop loss. And if there's no logical stop loss, you skip the trade entirely. Simple as that. Now, Rule 3 is your shield, the volatility buffer. This is just pure math. Say the market's average true range, the ATR, is 20 pips, and you place a 10-pip stop loss, well, you're a sitting duck. The daily market breathing alone is going to take you out. So the absolute minimum structural stop loss for volatile assets like gold, Forex, and indices must be the ATR multiplied by 1.2. You have to give the structure room to breathe without sacrificing your structural thesis. Rule 4 enforces what I call the one bias, one SL discipline. Before you ever click buy or sell, you need to look at your stop loss and ask yourself this exact, kind of uncomfortable question. If price hits this stop loss, does it mean my trade thesis is objectively wrong? If your honest answer is, well, no, the market could sweep it and still go my way, then guess what? Your stop loss is in the wrong place. Rule 5 really shifts the paradigm. A stop loss is insurance. It's not a punishment. It's not the price you pay for making a mistake. It is a structurally logical, model-based exit point. It has to be based on your model, not just placed super tight to ease your own fear of losing capital. Okay, Rule 6, the no trade zones. In these specific environments, placing a stop loss is basically financial suicide. You do not trade in the middle of a Wyckoff range. You do not enter in the dead center of an established trend. You never execute 30 minutes before high-impact news drops. And you step away the second the spread widens. In these zones, you just stop trading entirely. Don't even try it. Rule 7 is all about position sizing. This right here is the Wall Street standard. Notice that tiny slice? That is 1% risk, or honestly, even 0.5%. Most retail stop losses get swept because their lot sizes are just way too big. When your position is oversized, fear takes the wheel, and you physically force your stop loss closer to your entry just to make the dollar risk look acceptable to you. That is exactly how you hand your hard-earned money right over to an algorithm. All right, Section 3, combat execution. Here is exactly how a professional ICT trader actually builds a live setup. First, you identify the draw on liquidity. Ask yourself, where is the external liquidity sitting? Second, you do not front-run the move. You wait for displacement. You wait for a clear market structure shift, an MSS. And third, One structure actually confirms your bias. You place your stop loss behind the structural invalidation point, fortified by that ATR buffer we talked about. And please avoid this fatal execution error at all costs. Never ever place your stop loss exactly on the swing low or swing high. Why? Because that obvious structure is exactly where internal liquidity rests. The algorithm is going to wick just below that low to grab those orders before displacing in your direction. Your stop loss must be tucked safely beyond that obvious liquidity pool. It all ultimately comes down to the risk model. Pros adjust their position size to fit the market structure. Amateurs, they try to adjust the market structure to fit their position size. If the logical structural stop loss is wide, you reduce your lot size to maintain 1% risk. If the structural stop is narrow, you increase your lot size while still maintaining that exact 1% risk. Structure dictates the stop. The stop dictates the lot size. Finally, Section 4, the final verdict. I want you to burn this into your trading psychology right now. Pros only place their stop loss where the market is forced to prove them wrong. Let me say that again. The market rewards logical risk placement. It does not reward tight stop losses. It punishes them. You've got to stop giving your capital away to algorithms just because you want to feel safe in the short term. If you are serious about building a more institutional ICT execution model, and you actually want to trade with a cleaner, professional framework, there is a broker link pinned below. Stop trading like prey, start thinking like the algorithm, and let structure dictate your survival. Follow ICT market theory for deeper smart money concepts. Until next time, protect your liquidity and ask yourself, when you open your charts tomorrow, will you be the hunter or will you be the liquidity?